And so now we're going to go through some specific structure things on how to do just that. So first things first, for your main operating company to live on, the most efficient structure in almost every case now, if this is a business, is going to be an S corporation. If you got rental real estate, that's still LLCs taxed as a partnership or member LLCs. But using an S corporation for your operating company. So why is an S corp better? Somebody call it out. How do we save money with an S corp? Yep, we save on some self-employment tax. And now with the new law, in addition, you can save with 199A. So good idea, just got better. So then the question is, how much do we pay ourselves on our W-2? So if we get savings on K1, it'd be great to just have K1 income and have no W-2, right? But how come we have to do a W-2? Because the tax code says so. Congress said so. And they have to pay reasonable compensation. And the IRS wrote the reg, like pay for like services, whatever that means. All right, so here's 3 strategies to work for as you're making that decision. Strategy 1 is you go for the minimum reasonable amount, right? The lowest we can get away with and be able to sleep at night and be able to defend it in audit. So that's the first one. And so, for example, if you've got an S corp making 120 grand before you're paid, you could probably get away with, 50, 60K in wages. If you're making several hundred thousand, you're going to need to take that wage up to 100 grand. And 100 grand is going to get it done in most cases, with the exception of some professionals, certain professionals, physicians, and things like that, we may have to go higher. But in most businesses, if you're not in one of those professional trades, 100 grand is about the highest you need to go, and you can leave it there. All right, second strategy is put your wage at the Social Security limit. Now, this makes a lot of sense when you're near the end, closer to retirement. I tell or tell clients that if you are thinking of collecting Social Security within 5 years, we should probably have your wages up at the Social Security limit. Reason being is your Social Security benefits are based on a moving average. And that limit every year goes up, up, up. So what you're paying yourself at the end matters a lot more than you were paid when you were 30. So if you're within 5 years of collecting Social Security, it is our recommendation, the recommendation of a lot of planners, but I would get your wages up at the Social Security limit and ride it out. Now, third one, this is a situation where you take your wages high. And this is the wage limit for advanced retirement plans. When I mean advanced retirement plans, I mean profit sharing, cash balance plans, sometimes the new comparability plans, and defined benefit plans. And so if you're going to do one of those advanced retirement plans, meaning not just a basic 401k or a simple one of those, that's when it makes sense. And in my opinion, the only time you should take your wages up in that 270 range, or whatever the limit is this year. If you don't have one of those plans, there's really no reason to have a W-2 that high. But those plans can be extremely powerful when you have big income years, and those are very, very large tax deductions. These are great for physicians that, they're the first 10 years of their life, they're in med school and residency and then probably doing a specialty, and they're not entering the workforce and they're behind on retirement. Then they're hitting their big income years in their 50s, and this is a great way to make some taxable income go away. And since they're not eligible for Section 199A, there's a lot more value to those deductions.